This first video series is what we want to really kind of talk about is just step one, and really kind of just hammer home starting at the top of the markets. We call this the top-down approach to the markets, whereas the first thing you want to look at before you go look for individual trades and start prepping individual trades, you really want to get a bias towards the market. And what that means is the market bullish? Is the market bearish? Is it neutral? Now, there are many market indexes, but there are four core market indexes. The first one is the S&P 500, the second, the Dow Jones, the third one, the NASDAQ, and the fourth one, the Russell 2000. Now, the S&P 500 and the Dow Jones, those are what we call blue chip indexes. The NASDAQ, the Russell 2000, those are more growth-based indexes that do really, really well in bull markets, but get hit a little harder than your blue chip indexes like the S&P or the Dow Jones in bear market conditions. We want to analyze key market indices so that we can determine the identity of the trend. Bullish, we want to be bullish. If it's bearish, we want to be bearish. And I know that's very simple, and we'll go into it in a little bit more detail, but we simply want to trade with the direction of the trend. And the major trend that you want to really kind of focus on is the barometer of the S&P 500. The next step in the top-down approach to the markets is to analyze and break down the sectors. In the financial world, there are different components that make up the index. This is what we call a sector. There are 11 sectors, and they are broken down by aggressive sectors versus defensive sectors. The reason you want to analyze the sectors is some sectors will outperform the market, some sectors will underperform the market given what the market is doing, and we want to move into strength, we want to buy into strength, and we want to sell into weakness. So for example, if basic materials is outperforming, say, the S&P 500, I might want to look at some potential bullish trades in the basic materials sector. On the flip side, if real estate, XLRE, if real estate is underperforming the broader indexes, well, that might be a place I want to look for to add some potential shorting opportunities. So we want to rank the sectors based on strength or overall weakness in comparison to each other, but also specifically in comparison to that of the S&P 500. Next step down is that of specific industries, and there are a tremendous amount of industries depending on whether you're looking at S&P 500 or Dow Jones or NASDAQ or Russell 2000. And we don't analyze specific industries every single day, not even every single week, but every now and then you will see a industry really start to strengthen against the other indexes or show tremendous weakness against the other indexes. And then last, you want to look at individual securities and how you trade individual securities through buying stock, shorting stock, trading the options. So step one, when we're talking about the top-down approach to the market, is analyze the market indexes. Step two would be to analyze the sectors. Step three would be to identify what industries are outperforming, underperforming against their broader components. And then step four is we want to analyze and trade the individual securities such as the stocks, or if we're option traders, trading calls and puts instead of the individual components of the actual stock. Now, the reason specifically we want to analyze the market indexes is to determine what we call a market bias. There are three primary biases in the market. You have bullish, and in a bullish trend, you have price appreciation. The pattern in a bullish trend is very simple. It goes higher high, higher low, higher high, higher low. And as that trend develops, we want to be buyers in that capacity. So in a bullish trend, we want to be bullish. Very simple, but there are different categories of bullish as we'll get into here in just one second. Now, the second type of trend is what we call a bearish downtrend. And a bearish downtrend is just the opposite of a bullish uptrend, where you have price depreciation over time and you have a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. And as long as that pattern continues, we want to be sellers in that capacity. We want to short at resistance. We want to buy put options. We always want to move in the overall direction of the broader marketplace. And again, there are different categories of how strong of a bear you are or how strong of a bull you are. And that's all based on trends and patterns, support, resistance, and your technical skill set in terms of identifying momentum and the market cycle and economics. There's a lot that goes into determining what your specific bias is. But if you simply simply focus on the trend, that will cut out all the noise and help you identify simple bullish or bearish characteristics. Now, in a bearish downtrend, we want to be sellers. We want to short stock. We want to buy put options. We want to put ourselves in a position to make money as that market does in fact continue to go down. Now, take, for example, one of the greatest traders of all time, and one of the quotes he made. He said, "A prudent trader never argues with the tape. Markets are never wrong, but opinions often are." And that was from an individual by the name of Jesse Livermore, who is one of the greatest traders of all time. And what he's talking about is we don't want to form our bias based on our belief system. We don't want to form our bias to the market based on what we think is going to happen based on our own preconceived conditions. We want to focus on the trend. We want to focus on the numbers of the market because we lie to ourselves. Number one, bias is inherently subjective when you include our own personal belief system, whether that's from a political perspective or an economic perspective. It doesn't really matter. The price is king here. Focus on the price. Higher highs, higher lows. As long as we are bullish in the market, we need to carry a bullish portfolio. And as long as the market has a lower low, lower high pattern, we want to carry some degree of a bearish portfolio and thus look for bearish trades. Now, I mentioned that there are different components or categories to a bias in the market, and we always want to match the strategy that we are applying when you start getting into step 2 and step 3 of the 7-step guide. We want to make sure that we're applying the right strategy to the actual bias in the marketplace. And so from a bullish perspective, we categorize these as positive 1, positive 2, or positive 3. Positive 1 is what we call slightly bullish, positive 2 is what we call bullish, and positive 3 what we refer to as extremely or very bullish. And not very often do we get to the extreme levels, whether it's extreme bullish or extreme bearish. On the bearish side, we want to look at categorizations of -1, -2, and -3. And once again, -1 would indicate you are slightly bearish in the market. -2 would indicate you are bearish in the market. And -3 would be you are extremely bearish in the market. And right at 0 is what you consider your neutral type trends. Now, the types of strategies when you're in that neutrality from -1 to +1 are typically cash flow strategies like naked puts, credit spreads, calendar spreads, as well as covered calls, iron condors. Neutral type cash flow systems work really, really well when you're dealing with a slightly bullish to slightly bearish type of market. Now, when you're in a strong trending market, -2, +2 type scenarios, that's when you start getting into delta-based systems like buying calls, buying puts, swing trading, doing a little bit more aggressive type trading. And then once you get into your radical levels of +3 and -3, those are highly speculation type situations. And again, just a word of advice, pro tip, very rarely do we get to the ultimate aggressive versus defensive in the market. We like to be all things in moderation. We live in that +2 to -2 territory. Now, again, how we determine that bias is a few different things. Number one, we look at the trend of the market. We look at the trend of the sectors. We look at the market in relationship to the market cycle and interest rates. Economic conditions such as economic reports are coming out, earnings reports that are coming out. Sometimes we might want to be a little bit more hesitant, even in a strong trending condition, if there's a lot of economic reports or earnings reports coming at us in the next week. And so sometimes that can be fairly difficult if the only thing you are looking at is simply the trend of the actual marketplace. Now, at Tackle Trading, for our pro members that subscribe to the pro service of Tackle Trading, we send out reports every single weekend: a Tackle newsletter, a Forex report, a stock report, an options report, and a commodity report, where we rank all the different markets, the S&P 500, the United States dollar, all the different sectors from a bullish to a bearish capacity. And as you can see, we rank them based on a football field, where you have your +2, +1, 2, and 3 on the right-hand side, -1, -2, -3 on the left-hand side, and anywhere between 40 and 40 is what we consider that to be neutral. So every single week when we put out out our newsletter on Saturday and our scouting reports on Saturday as our pro members are preparing for the market that is coming up later on that next week. We send these reports out there and rank all the sectors, the indexes. We also rank all the different currencies out there in the Forex report every single week based on the things that I have been talking about. The same thing with the commodities out there as well. Now, in terming the broad market indexes, let's come back to that very top of the market for a second. There's different ways to analyze the top of the market when you're talking about your indexes. The first one is you want to look at just the actual index charts themselves. Now, you can't trade stock on the indexes, but you can trade options on those indexes, and a lot of cash flow systems like condors and credit spreads are done using the actual indexes themselves. The first one is the S&P 500, the second one is the Dow Jones, the third one is the NASDAQ, and the fourth one is that of the Russell 2000. Now, if you wanted to look at these in the futures market, which most traders, even if they don't trade futures, they look at the indexes to analyze the indexes on the futures chart because those are 24-hour markets. So /ES would represent the S&P 500, /YM would indicate the Dow Jones, /NQ would indicate the NASDAQ, and /RTY would indicate that of the Russell 2000. Now there are also ETF, which stands for Exchange Traded Funds, that also track those major indexes. And on the ETFs, a lot of traders and investors really like trading ETFs because it strips out earnings reports and you're looking at a broad major index, and instead of buying mutual funds, you get the basket of the diversification of a basket of different stocks out there in ETFs as well. So there are ETFs that also track the major indexes. The first one that tracks the S&P 500 is what is known as the Spiders, SPY. The second one is called the Diamonds, DIA. The third one is referred to as the Qs, QQQ, and then the fourth one is the Russell 2000, which is IWM. Now, the next thing we want to talk about is that of the sectors. There are, like I said initially, there are aggressive sectors and there are defensive sectors. Now, an aggressive sector will outperform defensive sectors in bullish conditions, and they will underperform defensive sectors in bearish conditions. So they do really, really well in bullish markets. They don't do nearly as well in bearish markets. Some of the defensive sectors can be also considered safe haven, such as some healthcare companies or utility companies or consumer staple companies. But of the 11 sectors, the aggressive sectors are as follows. You have basic materials, communication. Basic materials would be like you pull something out of the ground. Some energy stocks, oil drillers, gold miners, silver, copper, those types of companies. Communication companies, that would be like Facebook and Twitter and Google. And energy companies, XLE. Industrial companies like Boeing or Caterpillar, XLI. Technology companies, XLK, like Microsoft or Oracle or companies along those lines. Think Silicon Valley when you think technology. And then you have your consumer discretionary stocks, which are a lot of retail companies like Macy's and Dillard's and so on and so forth. So think retail companies when you're thinking consumer discretionary. Now, 5 defensive sectors are that of consumer staples, think food-based companies, real estate, XLRE, utilities, XLU, a lot of utility companies pay a hefty dividend, XLV, healthcare, and then XLF, which is financial. Now, the one thing I will say about the defensive sectors, it doesn't mean they go up in bearish conditions. Most of the defensive sectors will still go down in bearish conditions, but they will not go down as fast as your aggressive sectors. That's why they are typically considered a little bit more defensive. A lot of these companies will pay a little bit higher on the dividend. As you're analyzing the market cycle, the indexes, the sectors, and so on and so forth, and again, it doesn't take a lot of time on a daily basis, especially after you get a little bit of experience. The whole purpose of the top-down approach to the market is to make sure that we're trading in the direction of the market and make sure our bias in our portfolio is always moving in the direction of the bias of the market. But specifically, it's to go out there and find some trades that work really, really well in that specific condition. And that's what I want to talk about right now, is how to find a potential trade. There's a lot of different ways people find trades, whether we're talking, going to our broker software like a Tastyworks or Thinkorswim and running their scanning softwares. A great website called finviz.com has scanning tools that you can program your own scanning tools to find particular trades. ivestplus.com is another great software for people to be able to go out there and scan for potential opportunity. So there's a lot of great software that people will find either through, different websites or broker softwares or stock and options analytic tools like iVest. That is one way to go about that. And that's a good way to go about that. But what we do at Tackle Trading is we've created this entire ecosystem to help you do every aspect of your top-down approach to the market, from analyzing the market indexes, sectors, doing your daily routine, to going out there and finding individual trades to place trades and make some money, hopefully. So in terms of this, when it comes to the top of the market in step one, I want to quickly talk about some of the things that our members of Tackle Trading have access to help them analyze and apply their trading on a daily and a weekly perspective. First and foremost is our scouting reports. Every single week we put out scouting reports that help you find and analyze potential trades. We scour the markets to find the best technical trades in the market on a weekly basis. That includes the stock report, the option report, the commodity report, as well as the Forex report. So for every type of trader, we have a report that comes out on the weekend called the scouting report that lists out all the best technical trades for that specific week. Now, the second thing is the halftime report. Every single day on YouTube, we do what's called the halftime report, where we analyze the top-down approach. We analyze the market indexes, the sectors. We analyze individual securities every single day to help you understand and apply that top-down approach. In the Tackle newsletter, we rank all the different sectors for you on a weekly basis. Market recaps. We have an email service every single day called the Tackle Today that you can sign up for to get a list of everything we're doing at Tackle Trading on a daily basis. And then for those cash flow systems such as naked puts, covered calls, and even some credit spreads, we have what is called the Tackle 25. So to help you analyze and apply all of this stuff, we have this amazing community, the Tackle Trading community, help you apply, analyze everything you need to do on a daily and a weekly basis. So in the scouting reports, these are our swing trading picks. Halftime report, top-down analysis. Newsletter, top-down analysis. Market recaps, top-down analysis. Tackle Today, trading insights on a daily basis, and then you have your covered calls and your cash flow systems with the actual Tackle 25. Now, for those of you that have been enjoying the 7-step guide so far, we have 6 more sessions to go. But for those of you who do want to take advantage and sign up for Tackle Trading Pro membership, we're going to give you guys 15 days free on us. So what's in the box? What do you get when you sign up for a pro account? Number one, you get all rookie and varsity content. You get access to all of our blogs, all of our scouting reports, the stock, the options, the commodity, the Forex report. You get access to our Traders Lounge. You also have the coaches shows, which is every Tuesday, and the Cash Flow Club, which is every Thursday. You get the Mind of the Trader webinar series and the Tackle 100 series, where you have access to the Technical Analysis 101, Options 101, Futures 101, System Development 101 as well. And all you have to do is go to bit.ly/join Tackle Pro, put in a credit card, you get 15 free days on us. If you don't like it, unsubscribe. No harm, no foul. If you do enjoy it, stick with us. You'll love it. In our next module, step 2. After we've done all the analysis, what strategy do we choose? Do we buy stock? Do we short stock? Do we buy a call? Do we buy a put? Do we do a cash flow strategy? We're going to jump into all of that in step 2 of Tackle Trading 7-Step Guide to Trading. This is Coach Matt for Tackle Trading. I hope you enjoyed step 1, and now let's move on to step 2. Thanks for attending.